Hey everyone, Kyle Matthews here, CEO of Matthews, host of the Matthews Mentality Podcast, and also author of the Matthews Market Pulse on Substack. Today is our second quarter market update 2026, and today I'm going to walk you through exactly what's happening in commercial real estate and the economy right now, and most importantly, how you should be thinking about positioning yourself in this market. So let's just dive in. I got my screen here, I got my computer here. I'll be moving the slides myself. So let's go to, slide 2. The recovery is official. We're going to start with sales data. So when RCA, Real Capital Analytics, released this, we were generally surprised by how positive the data was. Dollar volume in commercial real estate was up, as you can see on this slide, 27% in the first quarter of 2026 year over year. As the chart says, the recovery is official. We are in the gold rush. If you look at this chart, you can trace the entire arc, the peak in late 2021, the rate hike driven collapse through 22, 23, and then this steady grinding, and I mean grinding recovery that's been building for 8 consecutive quarters now. First quarter 2026 came in at roughly about 136 billion for all asset types. That's the strongest first quarter we've seen since the market froze up. And the annual change graph, it tells the story clearly. We've now had positive year-over-year growth for 8 straight quarters, all right? So think about any industry, whether you're selling consumer products or in a service-based industry like ours, 8 straight quarters of positive year-over-year growth. I would say that's a good industry to be in. I'm going to move to the next slide here. As you can see, I love this slide. It really shows the relationship between price and activity for commercial real estate markets. So after the Fed's rate hiking cycle hit, both volume and pricing pulled back hard. But look at where we are now. Okay, pricing bottomed out and it's starting to turn up. Volume follows. But you know what's interesting is even though we have had 8 straight quarters of year-over-year growth, we're still at 2018 levels of pricing. Think about it. That's no appreciation on average for 8 years. And I'll move to the next slide here. You know, and I bring this point out because commercial real estate price growth, you know, over the last almost decade, if we call it up to a decade, it's fallen behind a lot of alternative investments. If you index this to 2001 instead of 2018, commercial real estate's much stronger as an asset. The takeaway isn't that commercial real estate's a bad investment. It's not. My personal takeaway, and I'm an optimist, I'm also a salesperson at heart, I'm a broker, right? The takeaway for me is that our industry is due for appreciation, especially given when you factor in the lack of growth over the last eight years, despite almost all of our demand drivers improving over that same period. Now let's get specific on volume, all right? Because sector matters a lot right now. Office, look at this, up 39% year over year. I know that surprises a lot of people, but this is distressed capital finally getting active. Deals are clearing at the right price and buyers are stepping in. Class A urban office is as competitive a leasing market as any right now. Trust me, Matthews, we have 30 offices. We're always opening new offices and expanding. We love Class A buildings, but not so much over the last 12 months. It's been competitive. We're paying these crazy rents. I'm sitting here saying, wait, what happened to the office apocalypse? I thought these buildings were vacant. They're not. Class A and core CBD districts is just crushing. It's better performance. It's giving investors more confidence as the assets are occupied. Industrial is up 27%. You know, industrial, man, when I die, I'm coming back as an industrial broker and investor because it's the most consistent performer out there and for good reason. Supply chains, e-commerce, reshoring, the structural demand story hasn't changed. Tariffs gave a boost to southeastern industrial markets like in Atlanta or Jacksonville, and we're seeing that shift in the sales and pricing data. If you look retail, I love retail. You know, it's always have a special place in my heart. It's up 3%, modest, but retail, particularly strip retail, has been one of the most resilient and underappreciated asset classes of this cycle. Now, it is worth pointing out, this is a year-over-year change. Part of the reason office is up 39 is because it's such a low year-over-year comp, such a low bar to clear to show growth, while retail, because they pumped $7 trillion into the economy, yes, from a capital markets perspective, pricing was negatively impacted, but the retail performance is as good as it's ever been in the 23 plus years I've been in the business. So retail has a higher bar to compete against in a year-over-year basis. So, growth rate here, it really reflects, in my opinion, the strength of the retail sales and having having recovered more than other property types. Apartments, this has been a tough one, up 1%. Multifamily is working through some serious supply overhang in the Sun Belt, but the long-term demand picture is solid. Construction starts are falling, sets up well for 2027 and beyond, especially given the country needs more housing to keep up with the demographics. This lag might be the best opportunity to get into a property type before the surge. I always say, I've been telling people, as I talk to especially some of the bigger owners around the country, multifamily is really kind of a tale of two cities, but it's really two stories. You have what I call, red states, Sun Belt, where on average, there's less regulation and people can build quicker, easier, cheaper. You have the oversupply. I just touched on it. But in the coastal markets, on average, more blue states, it's not a supply issue. It's really a regulatory issue. It's hard to get new product built. The product can't keep up with the growth, or just a lot of investment is scared. A lot of capital is scared to enter the market because they're concerned about increased regulation, whether it's rent control, vacancy control, rent stabilization, all of it. It just creates uncertainty, which kind of mutes investment activity and development activity. So the big number here, hotel up 64%, development sites up 55%. And and the number that jumps off the page, senior housing care up 194%, almost triple the volume year over year. Demographics are driving this. Baby boomers are retiring. Investors want to get in ahead of what they'll likely be the tightest seniors housing market in the country. But total across all the listed property types, 28% growth. Core four sectors, apartments, industrial, retail, and hotel up 20%. It's actually the data centers that pulled the growth down for 2027, which is the exact opposite of what happened last year. Let's jump to, what do we got? Slide number 7, there's no better industry to be in. This is what makes the first quarter number so surprising. The comparison in market growth in our industry versus everyone else's, all right? So commercial real estate, all the property types on the last slide, number 1 on annual growth. As an industry, we are outperforming every major sector of the American economy in terms of investment activity growth. If anyone asks you why you're in commercial real estate, show them this table. The opportunity for agents, for brokers today is unbelievable. And I love that. That's great news for us. Next slide, we're going to kind of touch on an overall economic update. We just touched on commercial real estate update. There we go. Now that we see where we are, let's kind of look at the overall economic backdrop, because this is where we can learn about what to expect over the next 3 quarters. Slide 9, I'm on slide 9. There we go. Slide 9, this slide captures exactly what's so confusing about this economy right now. We have 2 data sets moving in completely opposite directions. Now, what consumer sentiment? It's at 49.8. That's an extremely low reading, actually a record low reading. A stat like that would make you think everyone is doomsday prepping. But look at what those same people are actually doing. Usually you think consumer sentiment, well, people are going to pull back. They're going to save money. They're not going to spend. But look at those retail sales, all right? Retail sales in March 2026, I repeat, like last month, hit $752 billion, an all-time record. I was shocked by this. People are spending more money than at any point in history, even while they tell you, or they tell survey takers that they're worried about their finances. Either the survey takers need to get better, people talking outside of two sides of their mouth, or what could be happening, Americans are addicted to spending. That's probably what's going on. It just suggests that they're perhaps not as worried about their finances as they're communicating. Those headlines on the slide are just 4 days apart. Watch what people do, not what they say. So sentiment surveys, they measure feelings, right? Retail sales measure behavior, and behavior says the consumer is still in the game. But the divergence is real, and it matters for you how you interpret the headlines you're seeing right now. So let's jump into what we achieved how we achieved a pessimistic but an active consumer, okay? So just if you look at this side, it's titled Job Growth is Volatile to Start 2026, okay? It's been an up and down every other month since last fall, and the 3-month trailing average actually dipped negative at the end of 2025. I don't think enough people were talking about this. Just our internal charts at Matthews, our internal data, let alone data like this. I really prefer to look at the 90-day trailing average. In any given week or month, there's too much volatility. For that to have dipped negative at the end of 2025, that told us a lot. And the labor market's definitely weaker than it was before rate hikes began. AI, higher interest rates, fewer federal jobs. It's everything matters, right? It's all playing a role here. But as we go to this next slide, where we slide 11, but if you look at it, the job market is in balance. My personal opinion, that's a good thing. Okay. You got to remember, we're coming out of the single strongest labor market in American history. The weakening we're seeing today, I don't even want to call it weakening. I think it's actually more of a realignment. All right. Right now, we have about 7.2 million job openings and roughly 7.4 million unemployed workers. That's balance. What we have today is normalized, and normalization is what the Fed has been trying to engineer. Shout out to my boy Jay Powell, right? Average hourly earnings are running around 3.5% annualized, above the Fed's 2% inflation target, but not accelerating fast enough to materially move that inflation upwards. The labor market is healthy. It's not breaking yet, at least, but the weakening versus recent years, it's making people, especially young people, embrace that kind of doomerism, that doom and gloom messaging from the media. Next slide. We got to talk about the war in Iran, right? And what it's done. So the cloud that's been hanging over our heads recently, it's energy prices. So you can see it clearly on the chart. Brent crude spiked sharply when the conflict escalated, running all the way up near the $100 range before pulling back. As we sit here today, the figures back up near those highs. Energy prices feed in transportation, feeds into manufacturing, food costs, everything. Energy affects everything. And when you see a spike of that magnitude, even if it reverses, the CPI data captures it with a lag. And that's what we and the Fed are trying to navigate right now with the CPI prints. Moving on, because of that energy spike, if you just look at this chart, we're now forecasting, at least at Matthews, for CPI to reach 3.6% by the end of the second quarter. Inflation was running at 2.4 in February. It was actually trending toward the Fed's target. Then the war began. But here's the key nuance. This is an energy-driven spike. It's not coming from the labor market, government stimulus, or supply shortage. This matters. The reason this matters is because energy shocks are inherently more transitory. When the geopolitical situation stabilizes, which my hope is it will, and that's what I believe will happen, oil prices will normalize, inflation should follow back down. That's why energy in the CPI print is put into the top line, but it's not put into core CPI. But in the near term, the next 2 to 3 quarters, expect just top line CPI and inflation prints. They're going to be hotter than we were expecting at the start of the year. Let's see, moving on. All right, but what effect is that going to have on the Fed? Okay, so here's what the Federal Reserve is actually signaling. So here's the dot plot from the March FOMC meeting. It shows 7 members expect no rate cuts this year, 9 expect 1 to 2, 3 expect 3 to 4. The median expectation is still 1 to 2 cuts in 2026. Not much has changed. Despite hotter inflation, despite the energy shock, the Fed is not pivoting back to hikes, despite what some doom poster may say. It looks like the Fed believes, and I agree, correctly, I think this is all transitory, and that's kind of what they're messaging. Hey, I think Jerome Powell said this yesterday, right, Daniel? Like he said something to the effect like, hey, this is a one-time thing. God willing, when this conflict, this war ends, it should go back down. So, and here's why all this matters for commercial real estate. Even one rate cut would help us get back below 4% on the 10-year. We've already seen what rate stability alone has done for transaction volume. An actual reduction in the cost of capital would accelerate everything we're seeing in the data right now. In the commercial real estate world, we just need a rate that's stable below 4% to see these trends continue. We don't need interest rates to go back to pre-pandemic levels to continue seeing deal volumes rise at this 20% clip we've seen for the last couple of years. That would be amazing. Love to see 2%, 3% interest rates, but I don't expect that. And also more importantly, we don't need that, okay? So if you look on the next slide, don't be a doomer. I love it. This great title. We built a new index. We call it the Doomer Index. It tracks social media sentiment from some of the most influential business and political accounts on social media. This idea is simple. The loudest voices on social media are going to shape how the public feels about the economy. This is these algos are set up. It's like doom scrolling. They'll get you to click, and it's almost you almost have to think about it as a reverse sentiment index for the modern media. What we are conveying here is that social media accounts, shocker, have discovered that fear drives more clicks than confidence, and any bad news, it's going to lead to tons of doom posts. So don't fall for it. I'm talking to you. Don't doom scroll. Don't fall for it. That's not real life. Look at the actual data. look at the actual buildings and talk to the actual experts. Retail sales growing, job market balanced, deal volume up 27%. All right. Moving to the next slide. And so, how to play the market? Okay, here's how I'm thinking about positioning right now. So, first, treasury yields, in my opinion, should stabilize at a slightly lower level. The 10-year, it's been elevated because of uncertainty. You know, it's tariffs a year ago, it's geopolitics in Iran today. As those uncertainties resolve, yields are very likely to come in. And when yields compress, this is not rocket science. If it was, I wouldn't be able to do it. It's real estate. It's much simpler. Cap rates are going to follow when yields compress and asset values go up. Buyers getting in today, you guys are ahead of that repricing, okay? I don't think interest rates are going to go back to the sub 3% anytime soon, but we should be back below 4, in my opinion, during the second half of the year. All right. Second thing, the labor market and consumer spending, it's still growing. I know sentiment is ugly. I know the media, social media especially, makes the world sound scary. If it bleeds, it leads. And metaphorically, if it bleeds, it leads. If it's something scary, you're going to lose all your money. Everything's, it's over. It's so effing over. You're going to click on it. But the truth is, it's not over. Everything seems to be going pretty well. Okay. Historically, actual employment and actual consumer spending are the leading indicators that matter for commercial real estate demand, not how people feel about it on Reddit or Twitter or X or whatever. The fundamentals are intact. Recovery for segments like industrial multifamily, where new supply has been hammering operators. Okay, another thing to think through: pricing and deal volume will pick up quickly once the black swan events. So there's been so many black swan events over the last 7 years that I don't even think you can call them black swan events, just swan events. But it is going to settle as these black swan events kind of work themselves out, as they take care of themselves. The outlook here is really positive if the risk environment cools down. All right, a ceasefire in Iran could shift the market dramatically in a moment. All right. Fourth thing, and in my opinion, this is how you should be operating in a volatile market: be looking at deals right now. The investors and brokers who do the homework now, okay, who know exactly what they want to own and at what price, are the ones who are going to move first and win biggest when a volatile day gives them the prices they want and the interest rate they want. I can't tell you how many times I've looked back, whether it was during the GFC or even COVID, which was a much tighter period, but a little more severe. The most money was made by the people who bought deals before the recovery could be seen. All right. And even then, if you look at it, people who bought deals in 2009 and 10, when I went through this, 2009 and 10, we were still like scared out of our mind. It was like, I don't know what's happening. Is this ever going to change? But the people who bought deals in 2009 and 10 made the most. People who bought deals in 11, 12, 13, after the recovery had started, they still crushed. They still did great. But if you were really making to look a splash and you want to have the biggest ROI in your investments, it's really important to buy when the data suggests the market's starting to recover, but perhaps market sentiment doesn't match that. So, okay, the market, it doesn't give you a warning. You have to be ready to strike. And this isn't just commercial real estate advice, it's all investment markets. Okay, now I have to say, I think my CYA, I'm not an investment advisor, but it's like you do research on a stock before the price falls so you can know when to jump in. It's the same logic. Don't be the guy or gal who just looks for green stocks on Robinhood. The best deals I've ever personally done in my career were done when everyone else was scared. All right. So right now, some people, a lot of people, they're scared when they probably shouldn't be, moving on. Listen, I'm a real estate homer, so naturally it's no better industry to be in. I do want to come back to this one more time before we wrap. Commercial real estate up 28% year over year on the property types we showed earlier, up 20% on core asset types. If you're watching this as a broker, congrats. Like I said, we're in the gold rush. Imagine any industry where you get to tell your parents, you get to tell your friends, your family, someone at the bar, you're like, yeah, I'm in an industry that's growing 20, 30% a year. That's a great industry to be in. You're in the right industry at the right moment. I wish there was 135 billion in volume out there my first and second years. It didn't happen, but I survived. I promise you would too. That's the second quarter update. So wanted to make it quick, efficient, so you could get back. If you're a broker, you get back to making those cold calls. If you're a buyer, you get back to submitting offers. If you're a seller, you can get back to asset management, making good decisions for your portfolio. And if you're a lender, bring those interest rates down and give us some cheap money. But thank you, everyone, for spending some time with us today. If you want to go deeper on any of these trends or you want to talk about specific opportunities in your market, reach out to the Matthews team. Best in the business. We're here to help you navigate this market. And we have brokers, we have analysts, and we have just friendly kind people ready to get to work for you at a moment's notice. I'm Kyle Matthews. Hopefully, in the next time we sit down to film this, we're talking about another 30% growth we saw in Q2. Until then, let's go make that happen. Thank you.